I think the tone will be measured rather than hawkish. I think given the stronger data that we've just seen last week, there's probably going to be a bit of a change in the language. The Fed will need to drop the considerable time phrasing that they've used in the past. But I don't think that they're going to sound too aggressive in terms of immediate action on monetary policy. We're still looking for the Fed really to start raising interest rates from the middle of next year, from June of 2015. So I do think that the language will recognize the fact that the recent growth data has been better, and the recent both employment and earnings data has been better, but I think it'll be somewhat measured. Well, there's a range of challenges, really. The first is that as U.S. interest rates start to rise, there are many questions about how emerging markets in particular will react to that, and emerging market stocks as well will react to that rise in U.S. interest rates. So I think that's definitely one of the challenges. One of the second challenges is the fact that cheap oil is generally a beneficiary for equity markets, but there are winners and losers. And we've seen that in some of the emerging markets, which are energy exporters, have been sensitive to that trend. We've also seen that, for example, in some of the energy companies in other markets, and one good example of this would be the US oil producers or oil explorers in the fracking fields, which have a higher break-even in terms of their prices, and that would be one effect which could put a little bit of pressure on markets. I think a third issue which will be challenging is European growth, and the fact that European growth remains weak, and issues and concerns about whether we're already in a low-inflation or low-inflation period in Europe, whether we could start to move into a deflation period. This is something that Draghi warned about at the end of last week, and I think it'll also be a concern for equity markets going forward. So in that sense, I think next year we have quite a bit of divergence between global economies, and that's something that is going to have an impact on equity markets and on financial assets generally.